These four small-cap stocks all beat earnings, but three of them could still lose investors' money in 2026. Today, we're breaking down why using cash flow visibility, not headlines. We're not ranking stocks. We're not making predictions. And we're definitely not chasing hype. Instead, we're separating real operating leverage from hidden structural risk. So you can decide which of these actually deserves attention going into 2026. Before we start, here's how this analysis works and who this video is for. A true small cap opportunity isn't just a company with a low market cap. It's a business where future cash flows are improving faster than the market expects. Earnings beats alone don't qualify. Guidance credibility, balance sheet strength, and downside protection matter more. And most importantly, we think in risk buckets, not stock tips. If you're looking for certainty, this isn't the right video. If you're looking to understand why certain small caps outperform and why others quietly destroy capital, let's begin. Stock number 1, Great Lakes Dredge and Dock, GLDD. Let's start with the most boring stock on this list, and possibly the most reliable. Great Lakes Dredge and Dock does exactly what it sounds like. They dredge ports, waterways, and coastal infrastructure. This isn't glamorous, but it's essential. In the US, dredging is a highly regulated, capital-intensive business, and GLDD operates in something close to a quasi-monopoly. There are very few companies with the equipment, permits, and expertise to compete at scale. Why now? The small cap angle here isn't growth hype, it's visibility. GLDD has a record backlog of over $1 billion, which gives unusually clear insight into future revenue and cash flows. That backlog matters more than any single quarter, because dredging revenue is lumpy, but backlog converts. Bull case margins are expanding. The company's new Acadia vessel opens up higher margin offshore work. In infrastructure, LNG export facilities, and coastal resilience spending all support long-term demand. This is not a momentum stock. It's a compounding visibility story. Bear case. The risks are real. Federal budget priorities can change. Offshore wind timelines remain uncertain, and revenue recognition can be uneven, which scares short-term investors. What to watch: backlog growth versus conversion, EBITDA margins, and signals around federal infrastructure funding. Quick pause here. This is what low risk actually looks like in small caps. The next three will not feel like this. If you care about downside protection in small caps, this is the benchmark. Stock number 2, Heritage Insurance, HRTG. Heritage Insurance is one of the most profitable insurers right now, and also one hurricane away from serious trouble. To understand this stock, you need to understand how property and casualty insurance actually works. Revenue growth doesn't matter nearly as much as the combined ratio, which measures whether the company is underwriting profitably. Heritage's combined ratio recently dropped into the low 70s. That's exceptional. Why now? After years of painful restructuring, rate hikes, and pulling back from risky markets, Heritage has achieved rate adequacy. This is the point where insurers shift from survival to selective growth. Bull case. The company is reopening underwriting across more territories. Margins are strong, and management behavior suggests confidence, not desperation. If loss experience remains normal, earnings power here is meaningfully higher than the market assumes. Bear case. But this is insurance. Weather risk is binary, reinsurance costs can spike unexpectedly, and margin sustainability is always uncertain. A single extreme season can erase years of discipline. What to watch: combined ratio trends, reinsurance pricing, and geographic concentration of exposure. This is not a sleep well at night stock, but it is a deeply misunderstood one. Stock number 3, Magnite, MGNI. Magnite is the most complex business on this list, and arguably the most misunderstood. They operate on the sell side of digital advertising. That means they help publishers, not advertisers, monetize inventory. The battleground here is connected TV. As streaming grows, platforms want neutral partners who aren't competing with them for ad dollars. Why now? Regulatory pressure on dominant ad platforms has shifted industry behavior, whether or not it results in dramatic legal outcomes. Publishers are diversifying, and Magnite benefits from that trend. Bull case CTV revenue is growing at a double-digit pace, EBITDA margins are expanding, and integrations with major media platforms deepen switching costs. If CTV continues to fragment, Magnite becomes more relevant, not less. Bear case. Ad spending is cyclical, regulatory timelines are unpredictable, and competition, especially from the trade desk, remains intense. This is a structural bet, not a macro-proof one. What to watch: CTV revenue growth, margin expansion, and publisher concentration risk. This stock rewards patience and punishes complacency. Stock number 4, Serve Robotics, SRV. This is the most exciting story on the list, and this is where most retail investors confuse a great narrative with a great position, and the easiest place to lose money. Serve Robotics focuses on autonomous last-mile delivery. At this stage, revenue doesn't matter nearly as much as scale and unit economics. The question isn't, is this cool? It's, can this work economically at scale? Why now? Serve has secured major delivery partners and raised significant capital, extending its cash runway. Robot deployments are growing rapidly, and that matters more than near-term revenue. Bull case. If deployment growth continues and unit economics improve, revenue inflection could follow. Strategic partnerships provide credibility, and the optionality is real. Bear case, cash burn is significant, unit economics are unproven, and regulatory or execution missteps could derail the thesis quickly. This is not an investment, it's a calculated speculation. What to watch: robots deployed versus revenue per robot, cash burn, and customer concentration. Position sizing matters more here than the story. These 4 stocks should never be equal weighted. GLDD fits defensive, infrastructure-linked investors. Heritage suits those comfortable with cyclical, event-driven risk. Magnite appeals to long-term structural thinkers. Serve Robotics is for investors who understand optionality and accept loss. The key isn't picking the best stock, it's matching the risk profile to your temperament. Which risk profile actually fits you right now? Visibility, cyclicality, structural growth, or optionality? There are scenarios that break all 4 theses: rates moving higher for longer, a sharp recession, delayed regulation, or climate and geopolitical disruptions. Small caps amplify outcomes, both good and bad. Ignoring macro risk is not conviction, it's negligence. If you forced me to choose purely on risk-adjusted visibility today, GLDD stands apart, but upside rarely feels comfortable. And some of the most asymmetric returns come from businesses that look messy before they look obvious. This analysis is not a recommendation, it's a framework. Understanding why something could work and why it might fail is how you stay in the game long enough to win. If this kind of risk-first analysis helps you think more clearly, not trade more often, you'll probably find value here. That's the lens we use every week.